it's a matter of paying off the cash flows for investors in the type of funds that Kevin manages, its ability to take out capital every quarter if they want to by redeeming. But there's also a side of the investor which is looking totally long-term, and they're not worried about internal cash flow, they're not worried about liquidity. So if I can ask either Peter or Andrew to pick up on that and tell us where real estate fits into your portfolio from that point of view.
Sure, I'm happy to answer from Oxford owner's perspective, at least today. We have maybe an enviable position as a pension plan at owners to today have more contributors into our plan than we do actually being paid out of the plan. So that number's at about 3 to 1. It obviously has duration oriented to it, so as time goes on with it, new members coming in, that will become an issue as it would for any plan. But it allows us really to look at real estate as a component part. It does over long term align nicely with our liability streams as they continue to evolve over time. But it does allow us to take the perspective of being a total return investor. And all of our businesses and those private businesses take that position. And in fact, even our equity business is asked to be an absolute investor. It's not indexed. They're looking for returns that line up to our actuarial needs going forward, but allows us to maybe balance our book a little bit. I would still describe Oxford across its global investment markets as a core investor, but it would be on a more percentage basis, whether that number is around 60%. But then we do things like we build to core. And so I think development's talked a lot about today, and we happen to be a significant investor here in New York in the development space. And so we build to core, we buy debt and the capital structure to core, we lease empty buildings that we think will be core. And so I think we can take some of the risk associated with having cash flow not be the only driver of our return in various aspects of our platform.
But when your investment committee sits around and doesn't worry about the income stream, the cash flow stream over the next 5 years, do they worry about a date by which you need to turn this real asset into cash?
No, it's not a focus point. No.
Okay, so dramatic type of contrast. Peter?
So, Jeff, I think you're touching on a theme which has me, I think it's a fascinating topic. Very early in my career, I was always kind of perplexed how there were always so many buyers and sellers, because, if you have an efficient market, everyone should be trying to sell, everyone should be trying to buy. And then I kind of figured out, well, maybe it's people have different views on, what's going to happen in the future. And that's part of the answer. That's definitely part of the answer. And it was only when I joined a pension fund that I realized how every type of capital is completely different. And we all have completely different objectives. So I think even on just this panel alone, everyone has a different view on what capital requirements they have, what sort of returns they have. An example would be that we're focused on now is liquidity. Everyone likes liquidity. You want to be able to sell if you want to. Having said that, I think all investors have different levels of tolerance. We have a long-term investment horizon, so while liquidity is nice, we see if there's opportunity where the market's saying they want liquidity, well, we feel we have a competitive advantage. We know we don't ever have to sell, so we can see value where others don't, and vice versa. Where if there's a product that offers a lot of liquidity, we don't have a lot of, we're not competitive in that environment. So for CPP specifically, how we look at capital, our view is that all of our capital, and in fact that's how it's treated, can be invested instantly in the markets. When we receive cash, and I mentioned that's about $8 billion a year of cash inflows, that gets invested instantly. We don't hold cash. It goes into what we call a reference portfolio that's essentially about 65% public equities and 35% debt, different types of debt, but essentially debt. The role of our whole investment group, and that goes beyond real estate, it's our private equity and even public markets that has some trading strategies, is to add value to what we could achieve in the public markets. So it's a relative process where we look at real estate and say, can we achieve this either through what we call alpha, taking something that we think has a certain risk profile, replacing it with an asset in real estate, in our example that says we're not taking any additional risk, but because of our real estate expertise, we're adding value. Or similarly, there's something called beta that says we're getting access to a product that's just not available in the public markets. So everyone likes Brazil or China, well, you can't go buy too many Chinese real estate stocks. That's just not available. So you have to do it privately. And that's how we think we add value to what is a normal 65-35 equity debt type portfolio.
So you brought up